Financially raw, real, authentic wisdom with Lourens Oberholzer from Retire Rich and Happy.
So let's start, and before we start looking at the different strategies to pay off your bond in half the time, what we need to look at is how do they calculate the interest on your bond? Because once you understand that, then you can start using the strategies to your advantage and use the fact on how they calculate the interest to your advantage. So when you buy a car, what typically happens is there's an interest rate at the beginning of the contract term. Let's say it is a 4 years or a 5-year term, a 60-month term. They will then calculate the total interest over the term. So they will calculate how much interest has to be paid over the 5 years. That interest portion then gets added to your total balance, and you then have a monthly payment plan to pay off that interest over the term of your car repayment. So let's say, for example, you buy a car for 200,000 Rand. They then calculate the interest. The interest might be 75,000 Rand over the 5-year term. They will then add that 75,000 to your loan, and you will have a balance of 275,000 divided by the 60 months that you are paying it, and that will be your monthly payment. So you will pay off the interest over the period, and the interest is calculated at the beginning of the loan agreement. With a bond, it works a little bit differently. A bond doesn't go and they calculate the interest when you take out the bond or you buy the house over the 20-year period and then add it to your bond. That's why for those of you who have houses, who has a bond statement, it doesn't show you 3 million if your house only bought the house for 2 million. It shows you what is outstanding, which is basically the capital outstanding. And how they work the interest on a bond is they calculate the interest on the outstanding balance every single day of your bond. And then at the end of the month, they take all those daily interests and they add it to your bond, and that comes off your payment first. So they will then go and, let's say, for example, there's 1 million Rand outstanding on your bond today. The system or the bank, the computer system will calculate what the interest is. So let's say it's 10% of a million. That is 100,000 Rand. Divided that by 365 will then give you the daily interest. Tomorrow, if it's still a million Rand outstanding, that same daily interest will be added up. And at the end of the month, they take all of these daily interests, put it together, and that is the interest that you pay for that month. So once you understand that a bond's interest is calculated daily and added to your bond once a month, you can then use that to your advantage. Because whenever you pay more into your bond, whatever the outstanding balance on that day is will have an effect on the interest that you pay for that day. So for people who have access bonds, if you can leave money in that access bond for a period of time, or you have some money sitting in a money market account at the moment and you can move it into your access bond, let's say you drop that by 50,000 Rand by putting that savings into that access bond, every day the money lies in that account saves you interest. So how much interest do we pay on our properties? And because the term is so long, it is unbelievable how much interest we pay over a period of time. So I've done a quick calculation on one of our tools, our bond settlement calculator. And if you take out a bond for 1 million Rand at a 7% interest rate, your repayment over a 20-year term will be 7,755 Rand a month. So that will be your repayment. The interest that you will pay over that 20-year term is 860,000 Rand interest on top of your 1 million Rand that is outstanding on that property. So at the end of the day, that property that you bought for 1 million Rand is going to be going to cost you 1.86 million Rand. So just let that sink in. It's almost double of what you've bought that property for. So it's definitely in your best interest to try and get that down as quickly as possible. Because the quicker you pay off that bond, the more interest you save. And you can go look at it. I mean, these days, R1 million, you might have a R2 million property. That just doubles. Instead of 860,000, you now have almost 1.7 million in interest over your 20-year term. If you do it over a 30-year term, your repayment will be just under 6,700 Rand per month, but your interest on that property will be almost 1.4 million Rand interest. So your initial property of 1 million Rand will cost you 2.4 million Rand at the end of the day. So first and foremost, I don't suggest that people take out 30-year bonds. I mean, the savings that it gives you, which is about anything between 700 to 1,000 Rand per million Rand bond, is not going to be worth it against the amount of interest that you're going to pay over and above if you just do it over a 20-year period. Okay, so that is the first thing that you need to understand, is how the interest is calculated on your bond. So how do we get this bond paid off sooner? How do we make it so that you can pay off your bond in half the time? So there's three strategies. So the first one is easy. It is one that everybody knows, it's one that everybody can do, and that is to just pay in more every month. So let's say your normal bond repayment is 7,750 Rand a month. You add another 500 Rand or another 700 Rand or another 200 or even 100 Rand a month on top of that. Because every month you pay that comes off the capital directly. So it is very important that you do this, and it makes such a huge difference. The main thing why a lot of people don't do this is because they feel, but I can only put away 100 Rand a month extra or 200 Rand a month extra. What difference is that really going to make? So they don't do it because they think 100 Rand is so small that it won't actually make a difference. So I'm going to show you quickly. If we do an additional monthly payment. So again, I've used the same figures. We've got a bond of R1 million. It's at a 7% interest rate. Your repayments is 7,750 Rand a month. If you just add 100 Rand to that, you make it 7,850. You will drop your term over which you pay the bond with 7 years. 7 months. Sorry, guys. I wish 7 years. 7 months. So 100 Rand makes a 7-month difference. That is a savings of almost 55,000 Rand over the term of the bond for 100 Rand a month. Now, I am 100% sure that there's not one of us that can't afford to just add an extra 100 Rand to our bond. If we can take that and make it 1,000 Rand, you then drop your bond repayment term from 240 months to 189 months. It's massive. That is a change of about 50 months. It's over 4 years that you save by just adding an extra 1,000 Rand a month onto your bond. Total savings that you have over the term, 400,000 Rand that you are saving in interest and capital repayments over your term if you add an extra 1,000 Rand per month. So that's the first one. Start as soon as possible. Even if it's only 100 Rand a month, add that to your bond, pay it off a little bit sooner. It does make a huge difference in the long term. The second one, on the second strategy, you take an annual bonus, or you take your tax refund that you get, or maybe you sell something which is a capital amount that you're getting in. You can use that capital and put that into your bond as a once-off every year. So let's say, for example, you get a 13th check at the end of the year. Instead of using the whole 13th check for Christmas and your Christmas holiday, say to yourself, I'm going to take a percentage of that this year and put it into my bond. Whether that starts out with a 10% or a 20% or a 30%, you put that towards your bond, because that capital that you put extra into your bond immediately reduces the outstanding capital and reduces the interest that you pay. That's also why it's very important. What we teach in our coaching with our students is firstly to take control of your cash flow so that you have positive cash flow available, of which you can then put a portion towards your bond. Secondly, to have your capital expenditures planned up front through your reserve account. So the reserve account then has a budget for all your annual expenses. So if you get a bonus at the end of the year, you've already planned for the end of the year expenses, the Christmas presents, the holidays, etc., etc. So that bonus, that 13th check, you do not need to use for that. So you can put a big portion of that towards your property. So let's say, for example, you get a bonus and you can add 15,000 Rand at the end of the year additionally into your bond. If you do that every year at 15,000 Rand, that will bring your bond down to 180 months instead of 240 months. It's a 5-year improvement on your bond. The total savings over the term of the bond works out to 472,000 Rand. 472,000 Rand savings by taking a portion of your bonus every year and just adding it into your bond. Again, when we look at access bonds, which I believe everybody should have some kind of an access bond, even if you do that and you put it into the bond, that doesn't mean the money is now gone and you can never access it again. If there's an emergency, you will be able to access that bond again. So those are the first two strategies. The first one is just take a little bit of extra cash flow and put that towards your bond on a monthly basis. You can do that by either just paying it in. A lot of the banks allow you to just do a transfer on your online banking extra, or you can even talk to the bank and ask them to increase your debit order that goes into your bond. Secondly, you can take your annual bonus, your tax refund, and make annual payments. Once a year, you add an extra capital into your bond, which will make a huge difference as well. So we've done 2 strategies so far. We've said you can pay a little bit extra every month, as much as you can, but every little bit helps, even if you can only add 100 Rand a month. Secondly, make annual payments. If you get a bonus, if you get a tax refund, take that money and put it into your bond. Preferably make sure that your bond is an access bond, so that you have access to that money again in case there is an emergency. So what is the third one? So the third one is something that very few people actually think of, and it is one of the most powerful ways to pay off your bond. And how that works is, if we look at life, if we look at inflation, every year everything goes up. The food goes up, our groceries, our water and lights accounts, electricity goes up. All of these things increase every year. Our short-term insurance increases, our medical aid increases, our long-term, our life cover increase. Everything, all our expenses increase, our salaries increase. But what do? We tend to pay the same amount on our property for 20 years. So what we suggest with the third strategy is to look in the month that you get a salary increase. You take a portion of that salary increase and add that to your bond repayment every month. So let's say, for example, you get a 10% salary increase every year. You can then take 7% of that 10% and add that to your bond repayment. Because what that does, even if you do 10%, it basically puts you in a cash flow neutral situation. Because if your income increased by 10%, your bond repayment increased by 10%, the ratio stays exactly the same. What I just want to suggest is that you do this immediately in the month that you get your salary increase. That first month where your salary is higher than it was before, you want to implement that change immediately. Again, you can go talk to your bank and ask them to increase your debit order so that you get used to that expense. The problem is, if we don't do it immediately in that month that we get our increase, our expenses tend to expand and it swallows that increase, and before we know it, we won't be able to do it anymore. They estimate that any salary increase, any new job that you get to with a higher salary, within 3 months, your expenses have absorbed that salary and it hasn't made any big difference to your life. You're in exactly the same situation as you were in before. So let's have a look at it. So let's say, for example, we have the same scenario we've been working on this morning. R1 million bond, 7% interest, repayment of 7,750 Rand a month, and you increase your repayments with 7% every year. So the moment you do that, your bond repayment goes down from 240 months to 136 months. So that is huge. It is 105 months difference. That is almost, 4 years, almost 10 years, about 8 years, 9 years difference that it makes. The total savings over the term of your bond is 813,000 Rand that you are saving by just increasing your bond repayment with your salary increase at, say, 7% every year. That's huge, and not a lot of people think about doing something like this. So how do we then pay off your bond in half the time? We take a combination of all of these. The first thing is, let's say you add an additional payment of 500 Rand a month. You also add in 12,000 Rand as a lump sum or a once-off payment every year into your bond, and you then increase your bond repayment by 7% every year. So the moment we do that, we have reduced your term from 240 months, which is 20 years, to 117 months, which is just under 10 years. So that is exactly half the time. And it's as simple as that. You take 500 Rand a month, you put 12,000 Rand per annum. You can also change it around and put 1,500 Rand a month and no lump sum, but that's up to you. 12,000 Rand per annum is a lump sum, and you increase your income by 7% every year. Not your income, your payment on your bond by 7% every year, and you have paid off your bond in half the time. Total savings over the term, 961,000 Rand. That's almost a whole new property that you could buy with that money that you've saved over the period. So yeah, it's as simple as that, guys. A couple of things that I want you to really think of when you start looking at buying a property, and if you've already bought a property. The first one is, when you start planning to buy a property, you need to find out all the expenses related to that property when you do your budgeting. Don't just look at what your bond repayment is going to be. Make sure that you understand all the hidden expenses, the rates and taxes, the extra maintenance that it's going to cost you to maintain that property, the insurance that you have to take out on that property, the building insurance, the homeowner's insurance, as well as life insurance that the bank might expect of you to cover the outstanding loan. All of that are extra expenses that you need to look at when you decide if you can afford this property or not. One of the things I want you to also keep in mind is, when you do buy a property, the banks very often add homeowners insurance to your property. So the first thing you need to understand is, there is no obligation of you to take out that insurance through the bank. So firstly, yes, the bank can make it compulsory that you have the insurance. In actual fact, all banks will make it compulsory that you have homeowners insurance on that property, because they need to make sure that if something happens to that property, it is insured, because that asset underlines the debt. But there's no obligation on your side to do it through the bank. So firstly, shop around with your homeowners insurance to get the best premium. Most of the time, if you add your homeowner's insurance to your existing short-term insurance policy, your existing household contents vehicle insurance policy, it will be cheaper than what the bank will charge you for that insurance. Secondly, if the bank does it, very often I've seen it that they do it as an annual payment. So they take that insurance not on a monthly basis, they do it annually. So let's say, for example, the insurance is 1,500 Rand per month. They will then add it as an 18,000 Rand annual premium. And then they add that annual premium to your bond every year. So the problem with that is, again, if you look at the way interest is calculated on your bond, you are basically adding 18,000 Rand debt to your bond. That goes to the outstanding balance. And then what happens is you pay interest on that insurance premium, which is not something that you want to do. So you always want to have that as a separate payment from your bond. It has to go off your normal bank account, whether it's through the bank or whether it's as part of your normal short-term insurance. So guys, have a look at that. Make sure that you don't have that as part of your bond and are paying interest on your insurance premiums. Secondly, a lot of the banks offer you life cover. What we usually suggest is that you look at that life cover as part of your holistic portfolio of risk benefits, not to take out a specific policy at the bank, because what typically happens is a lot of the banks give you a decreasing cover facility, which means you pay more and more and more every year, but your cover reduces because all it does is it settles the outstanding balance. So it becomes a very expensive kind of insurance that they put on. A third thing that I want you to keep in mind when you do look at these kind of things is get insurance where you are properly underwritten at the moment of inception. What that means is if you take out the insurance, go for the medical tests, get the blood tests done. Make sure that the insurance company has underwritten your risk at the start of the policy. These policies where they say you don't have to go for any medical tests, you just answer like 10 different questions, those are problems waiting to happen, because they then underwrite at claim stage. When there's a claim, they'll look at those questions you answered, and usually it's like a quick no, and then they pick up something like you had high cholesterol or you had a heart attack or whatever, and you haven't declared it in those quick questions, because usually we typically don't even read those questions, and then it becomes a problem, and you are not there to defend yourself, you are not there to fight on behalf of your family, and then it becomes a huge issue. So make sure that when you do this risk cover, you get properly underwritten from the start. Okay, so just to look at planning for a big expense. The first thing you need to understand, if you are in the market to go buy a property, you maybe want to buy your first property, how do you know that you can afford it? The first thing you need to understand is that it will be much more expensive to buy a property that is similar to the one that you are renting at the moment than it is to rent that same property. And you have to keep that in mind. Typically, people don't want to rent a property and then go buy something that is of a lower standard than what they are used to. They might have a 3-bedroom townhouse in a good area, and to have the same monthly expense, they need to downgrade to a 2-bedroom in a worse area. And most people don't want to downgrade. I mean, you don't want to be a tenant and then move into your own place and be worse off than you were as a tenant. And typically, to buy the property that you are renting at the moment is going to cost you much more than it's going to cost you in rent. Like I said earlier, there's a couple of things that you need to keep into account over and above your bond repayment. The first one is the rates and taxes that needs to be paid on that property. The levies that you might have if you're in a sectional title, make sure you understand what those levies are. Make sure you understand the insurance. Is the insurance part of your levies? Do you have to take out insurance on your own and make 100% sure that you're not double insured for that property? And then the next thing you need to look at is the maintenance on the property. How much is it going to cost you every year, and budget for that, for maintenance. Guys, properties always cost money. There's always something breaking down, something that needs to happen. So properly budget for that. So if you really think that this is something that you want to look at, I'm going to give you some tips to plan up front so that you don't get into trouble. Because the one thing you don't want is to at last buy your own place where you feel this is now mine. and then 3 months down the line you can't sleep because that property has put so much stress on you financially, and then in a couple of months time you don't only lose the property, you might need to sell it for a loss, you might need to lose your credit worthiness because now you can't afford all the expenses of the property, and 6 months or a year or 2 years later you're in a worse situation than you were renting. We don't want those kind of things to happen. So one of the things I want to also chat about is how do you make sure that you don't buy a property and overcommit yourself, that you can actually afford this property. So the first thing you need to do is you need to stop trying to keep up with the Joneses. Especially if you're in your 20s, early 30s, you look at your family, you look at your friends, they're all buying properties, and now you want to buy something that is in the same range or the same value as them. Don't do that. Look at your life. You are not in competition with anybody. You're not in competition with your friends or your family members or your brother or sister. It is about doing what is right for you. So it is very important that when you do buy property, you want to keep the emotion out of it as much as possible. Look at the figures. Have somebody sit with you, preferably a financial coach. Sit with you. Go through the expenses, make sure you don't miss anything, and calculate exactly what this property is going to cost you and how much extra per month it is going to cost. So that is important. Don't keep up with the Joneses. Do what is best for you. It might feel like you are a bit behind in the short term, but in the long run, I promise you it's going to put you in a much, much better situation by having that discipline and not overcommitting yourself. What you must remember is that we all have what we call an itch cycle. You get to a period of time in your life where you get into this itch cycle and you want to do something, buy something, make a change. That is a very dangerous place to be, is that itch cycle. And what typically happens is we make big financial decisions while we are in this itch cycle. And the itch cycle is all about you want to have the change now without really focusing on the logistics and the actual effect of that expense. So it then becomes a purely emotional decision. That's what the itch cycle is. It's an emotional decision. So it drives you through an emotion to make a decision in that period of time. So what I always suggest to people, if they are looking at a big purchase, whether it's a new car, a new house, anything like that, and they are in their itch cycle, do your research and then wait for at least a week, preferably 2 weeks, before you put pen to paper, before you make that decision. Because usually after about 7 days to 14 days, the itch cycle has passed, and you can then make a more informed decision on whether this is the right way to move forward or not. So how do you make sure that you can actually afford this new property, this new car, this new lounge suite, any of these big purchases? I'm going to run through that. It's called a trial purchase. I'm going to run through that with you guys now, and it's a strategy that you can use very effectively to make sure that you don't get yourself into financial trouble. Got a message here from the website. Thanks, Darren. It says the info is great. I need a coach. How can I contact you, please? So we're always willing to help. So Darren, you can go to our website, retirerichandhappy.co.za. At the top, you'll see a tab called Financial Coaching. You can click there, and you can then just register for one of our coaching presentations. It's usually on a Tuesday evening on Zoom. And on those presentations, we explain exactly how the coaching works. If you don't want to wait, if you are really serious, you want to get going immediately, you are welcome to phone our office at 087-809-0603. I'll say that number again, 087-809-0603, and you can speak to one of the people at the office. You just tell them that you are interested in getting a financial coach, and one of our coaches will be in contact with you and explain everything on how this process and this system works to help you with your finance and to get you to retire in 10 years. Okay, so before we finish, let's quickly talk about the trial purchase, and then we are done for today. So what you do with a trial purchase is, if you decide you want to make a big purchase, you want to buy a new car, you want to buy a new lounge suite, or you want to buy a property, the first thing you do, you sit down and you make sure that you understand exactly what all the costs are. What are all these costs that this purchase is going to bring into your budget? You then compare that to what these things are going to cost you, or what it costs you at the moment. So let's say, for example, you pay rent of 7,000 Rand per month, and you want to buy a property that is similar to the property you are in at the moment. The bond repayment on that property might be 8,000 Rand, but now you have to pay insurance, you have to pay rates and taxes, and maintenance. So let's say, for example, the total expense is going to be 10,000 Rand a month. You then decide that you do a trial purchase. So what you do is you assume that you have already taken that purchase or made that purchase, and that is your expenses going forward. So let's say, for example, the difference between what you're paying now and what you're going to pay is 3,000 Rand a month. You then need to put that 3,000 Rand a month into a separate account, a savings account, your reserve account, as if you are paying this expenses already, and you have to be disciplined with that for at least 3 months. So for 3 months, you want to put that 3,000 Rand a month away. And I promise you, within that 3 months doing this, you will very quickly realize whether this is going to be something that you can easily afford, or whether it's going to create financial struggles. Because the first or the second month, you have to put that 3,000 away, and suddenly you go, oof, if I put this away, I'm going to not come out this month. You will very quickly realize that you're biting off more than you can chew. The second benefit to this trial purchase is that at the end of that 3-month period, you have an extra 9,000 or 10,000 Rand that you can put towards the cost of the registration of your property, or the extra into your car, or whatever the case may be, an extra deposit on your car. So look at these kind of things. Do a trial purchase for 3 months. Guys, I know it sometimes feel like, oh, now I have to wait another 3 months. I promise you 3 months goes by like that. So take that time, take that 3 months, and make sure that you can actually afford it. Because I'd rather wait 3 months and know I make the right decision than jump into it and in 6 months' time I lose my property and I'm financially stressed, my credit record is shot. You don't want to go down that route or that path. Guys, yes, that is our talk for today. We are at 10:56, so we've got 4 minutes left, exactly enough time for one last song. Thank you very much for joining me. I hope the information that I shared with you this morning is going to be helpful. Again, if you have any queries or questions, you're welcome to go onto our website, retirerichandhappy.co.za. You can follow us on Facebook, Retire Rich and Happy, Instagram, Retire Rich and Happy, YouTube, Retire Rich and Happy. You can follow us on all of these platforms, and I hope to hear from all of you soon.
Financially raw, real, authentic wisdom with Lourens Oberholzer from Retire Rich and Happy.